Thanks for joining us on the Friday Eve. And we would like to introduce you to Satyakam Gautam. So Satyakam is a graduate of DCE 2003 batch, and he's a mechanical engineer by trade. He has done his graduation from IIM Lucknow. He has more than 15 years of experience across trading global debt market as well as Indian fixed income market. He has invested across government securities, corporate bonds, and money markets in India, as well as interest rate futures market of Europe and US. So we want to learn from his experience. So this is the second webinar in the series where we want to learn from Satyakam's experience and from his knowledge. In the first webinar, we discussed about the broad contours of debt market. So we learned who are the main participants in the debt market, how big it is, and we learned that it is bigger than the equity market in the world. And who are the regular investors in the market, and how should a retail investor look at that, and what are the different factors that one should evaluate while participating in the debt market. So our endeavor is now to understand each of the aspects of the debt markets in detail. And to start this, we have divided the entire session of 45 minutes into three parts. In the first part, I will be introducing Giraffe. I'll give you 3-4 minutes of overview who we are and what we do. And then I'll hand it over to Satyakam, who would then explain us the factors that affect the debt market. So there are many factors, and we will be covering some of those only today. And in the next section, we will go much deeper. So one session is not enough to learn about them. And in the last session, we would encourage our audiences to ask questions. So the Q&A section is enabled. You can type in your question. And last time we have received the feedback that there are some terms which we use which are technical, and I would like to apologize in the start because we have been in the market for 14-15 years. So at times we get carried away and take some words for granted. So if we do that, please feel free to type it in the Q&A box, and we will try to address it as much as possible. And if you have any further queries, you can ask us at the end of the session, or you can email us and we'll get back to you. So with this, I'll just share my screen and introduce Giraffe and who we are. I hope you can see my screen, Satyakam.
Yes.
Yeah, so Giraffe is an alternate investment, a high yielding platform. And its co-founder are Saurabh Ghosh and Vineet Agarwal. Both of them have almost a decade's experience, and they have been finance professional. And we launched our platform on September 10th, which was Ganesh Chaturthi. And we have Pratik Goyal, who is our head of strategy, and I'm Vikas Bansal. And you all know me, it's the second time I'm coming on this webinar, so I'll move forward. So coming back, why there is a need for Giraffe to exist at all in the market. So currently the investors have only two types of choices. One thing, either they can invest in fixed income products, which is mainly the FD, and in current scenario, they offer around 5 to 6%. Or second option is you invest into direct equities or through mutual fund, which are equity exposure and market linked returns. So these are the only two sets of category. On the one hand, you have very highly safe instruments, which are FD. On the other spectrum, you have market linked returns. So there's a wide gap which is missing in the market. So Giraffe is trying to bridge that gap. So these are the products which have been available, and these are nothing new. It's just that they have not been accessible to the common people. So what we are trying to solve here, we are trying to bring these opportunities for the retail people. We are trying to bring down the size of investment. So if you were to go and shop in these, invest in these opportunities, it will be somewhere north of 50 lakhs to 1 crore. So this is what we are trying to do. So what do investors and partners gain? So you can go through all the opportunities are listed. You can evaluate yourself. You can understand the risk, and if you want, you can invest through it. And what is the yield that Giraffe offers? So we are working in a space which are 8 to 20%. These are multi-tenor opportunities. You can invest from 3 months to 3 years. So 3-month products are more of liquidity products. 3 years are giving you passive income. So as per your requirement, one can invest and in these products. I've already spoken about the team. We have a credible team. We have two founders who have more than a decade experience. We have Pratik, who himself has been working with private equity and leasing and venture debt. So we derive a lot of comfort from the experience, and these are the people who curate the opportunities on the platform. So just to give you a brief overview, these are the 5 products that we deal with. So NCDs and MLDs of NBFCs, which is mainly the corporate debt, which can range from 12 to 30 months. Invoice discounting, by nature, it's a working capital product, which is very small, 1 to 6 months. Corporate debt, so corporate debt could be real estate debt or any other normal corporate, which is not an NBFC. Leasing is another asset class where everyone knows the rental, so rental economy. So these are the products which give you the passive income. And another exotic product is venture debt and revenue-based financing. So each of them have a different tenor, different risk, and the yields are different. So these are the broad spectrum that we deal with. So our forte is the fixed income or fixed return products that we bring to the table. So that's a very short overview about Giraffe. So I'll now hand it over to Satyakam, and Satyakam, you can carry on, and in between I'll keep asking you the questions. So just to set the tone of the today's webinar. So I think the debt market, as we understand today, is the only factor I understand is the interest rate. So if the interest rates goes down, the cost of capital of borrowing increases. So it would be helpful if you can elaborate on this part and let us know what are the different factors.
Thanks, Vikas. So a very good evening to all. So today we are going to cover some of the few macroeconomic factors which affect the debt markets. And there are almost, I think, broadly speaking, there are 9 to 10 major factors which affect debt markets, either local or global. But today we are going to cover 3 major ones. First one is inflation, second is GDP, and the third one is the fiscal deficit. So we'll start with inflation, and then Vikas, you can ask me questions if you find anything interesting in the presentation. Okay. So these are the broadly the 8 to 9 topics which I find affecting debt markets in one way or another. Beyond inflation, GDP growth, fiscal, the G-Sec yields, repo rate, trade growth, deposit growth, current account deficit, balance of payment. These are some of the topics which perhaps affect the debt markets. Now, this chart is the chart of consumer price index for India. So if you look at the CPI data, this chart, if you just look at this data is since 2012. So broadly, we have been around 6%. If you look at the last month reading for the month of March, we have gone to 6.95. If you look at the readings on this chart, you would appreciate that January, February, March, all these 3 months, the CPI readings were above 6%. Okay. And for the complete fiscal 2022, the average CPI was 5.5. For the last 2 fiscals, the average CPI was around 5.6. Okay. So we are broadly around 5.5, 5.75 for the last 2 fiscal years. Okay. Now, the next slide is for WPI wholesale price index. This chart is very interesting. So this chart shows that right now the WPI for the last month of March is at 14.3%. And if you look at the entire FY22, the average was around 12.5, 13%. That is a huge number. I think that is the highest for the last 30 years recordings if you want to look at data. So that's exceptionally high number from a WPI point of view.
So Satyakam, just a small question.
Yeah.
So if I understand correctly, inflation, the measurement of inflation, so what we call in Hindi is महंगाई. महंगाई is measured by CPI and WPI. Correct? And since you mentioned the chart on CPI, you have shown that it has been inching higher. So I can see that from this chart, it has gone below 2%, and somewhere before 2013, it was above 10%. So what is the optimum level, one would say, for so if it is 6.9%? So you mentioned that after January, it has been more than 6%. So what? Like, is it too much? Is it too less? what is the band that one has to look at?
So the legislative mandate to RBI is that the CPI for India should be in a band of plus minus 2% of 4%. So the band is from 2% to 6%. Okay, so that's the legislative mandate from to the RBI. Broadly, for an emerging market country like India, I feel that around 5 to 6% is anyways which was required for a optimum output growth. Okay, so that is the trend, and that is what we should be expecting. But post COVID, the world economy and the local economies have gone too many changes too fast. So we might be seeing very high numbers in local economy too. If you look in the chart in 2013, when the taper tantrum was there, then we had seen numbers like 10%, 12% on CPI. Right now, fortunately, we are still only 6 to 7% right now. Okay, but looking at global inflation backdrop right now, I would not be surprised that if we also start seeing higher numbers as we move ahead in the next 6 months.
Okay, so I can understand if inflation is high, it impacts the common people, and the purchasing power for the common man reduces. So if we go to the market, we can buy the less amount of the same stuff. So I
Right.
understand that large inflation, if it goes beyond the legislative mandate, as you have beautifully mentioned, beyond 6%, it starts pinching the common people. But what about below 2%? The things are cheap. Why not enjoy it? What's wrong with that?
I think there are two facts. First, India is an emerging market country. It's a developing country. For a developing country or emerging market, you can't have a CPI below 2% because that is not the way how productivity works in an emerging market country. The factors of production like land, labor, capital are not so productive in case of emerging market countries. So it's very rare to see CPI around 2%. In cases of developed markets like US, Europe, where the productivity is very high, there you would have seen 2% CPI for a long period till 2019-20. So the contours of CPI for a developed market and emerging market is like that. Emerging markets traditionally have around 6% and developed markets have around 2%. But this theory is right now changed. It has gone completely opposite right now. Developed markets like US has around 8.5% CPI, Eurozone has around 7.5%, UK has around 7.4%, and emerging market like India has got around 6.95. So it's not the same rule book anymore post COVID world. So we will see.
Okay, so CPI is something the price that a consumer gets to pay. Wholesale price is what the producers feel the pinch, and moving
Yes.
on,
So,
you can
yes. So
explain
we'll
us the
come to
difference.
that slide as we move ahead.
Sure.
Yeah.
Carry on, please.
Yeah. So basically, this is a slide which explains the difference between CPI and WPI. Now, CPI measures the changes in the price of goods and services at the point of the retailer. Okay, whereas WPI, it measures the inflation or the increase in prices at the wholesaler points. And mind you, it is only for goods. There is no services in WPI. Okay. Now in CPI, the maximum weightage of around 46% is assigned to food and beverages. But if you look in WPI, the weightages are, let's say, 64% for manufactured goods, 22% for primary articles, and then remaining 13% for fuel and power. Now, if you look at CPI data for FY22, it was 5.5%, as I earlier mentioned, whereas for FY22, WPI was 12.9%, which is the highest in the last 30 years. So that's the difference between these two indicators.
Why would that be? Like, if the producer is getting the goods at 13%, shouldn't the CPI should also be the similar amount of increase?
Exactly. So ideally, CPI is related to WPI in the sense that if WPI remains high for a fairly long period of time, it has to feed into CPI, because it is unimaginable to see a, let's say, wholesale producer seeing inflation of 13% and not being able to pass through that price increase to the end consumer. But unfortunately, when the demand situation in the economy is not that strong, then maybe the wholesale producer is not able to pass the entire price increase to the end consumer. And that is perhaps one of the reasons why CPI has been lower than WPI, and it has perhaps not increased as much as WPI for the past 1 year or so.
That's interesting. So producers have a limited capacity in the case of weak demand or a tepid demand. to pass on the price increase to the consumers. So there is a lag between the two indicators. Have I
Correct.
understood correctly?
Correct, sir.
Okay.
Now, if you look at again inside CPI itself, the CPI inflation for services for FY22 was 5.1%, whereas for goods was 6.2%. Now, why the difference? The difference being because if you remember FY22, we had the second round of COVID around April, May, June, and then there was a third round, Omicron, around December, January, February. So whenever there is a lockdown situation happening, services are the first sector to get affected, and hence services tend to get discontinued at that point of time, and hence the CPI tends to be lower for services for FY22, whereas for goods it's higher. If you look at WPI, even at the category of goods, CPI inflation has been much lower than the corresponding WPI. Reason being the producers, the wholesale producers, are not being able to completely pass on the price increase. For example, I'll just give an example. Let's say the price of auto vehicles, let's say four-wheelers. So let's say that there's been an increase in price of aluminum, let's say in the price of metals to an extent of, let's say, 15-20% on an average in FY22. But will an automobile company be able to pass the entire 15-20% increase in cost to the end consumer, especially when the rural demand is not so strong? I think no. So you would have seen maximum 3 to 4% increase in prices of automobile companies, whether it is Maruti, whether it is Hyundai. So that's the trend. So, I mean, whatever there's an increase in cost on their side, they are perhaps able to pass to 30-40% of that cost to the end consumer. And that's why even for most goods, CPI inflation is currently lower than the corresponding WPI.
Correct. So I can see from the graphs that you have said WPI is all-time high. So I'm assuming in the future, because there's a lag between CPI and WPI, would the CPI prices will keep on increasing, and we would say if not 15%, so maybe 12 or 10%. Is that the future?
No, I think my trajectory for CPI is for the month of April, I will see around 7.5% plus. For the month of May and June, I'm expecting around 6.8, 6.7. So for entire Q1 FY23, the number should be around 6.9%. And for the entire FY23, my estimates is like 6.6% for CPI. And for Q4 FY23, I think it should be around 5.75. So my sense is it should be around, for entire FY23, average should be 6.6%. Even that number is a significantly high number, and that number defeats the legislative mandate being given to RBI, because the legislative mandate is that the CPI, if it is more than 6% for 3 consecutive quarters, then the central bank has to reply, or let's say give some kind of response to the parliament or legislature that why this has happened, what steps are being taken, in what form. So that is the cause of concern from a monetary credibility point of view.
Okay. So I've understood, and I think our audiences must know what is inflation and how is it measured. And we have also learned that CPI is at a fairly high level, which is beyond the comfort level of RBI and the legislative mandate to be more accurate. And WPI is at an all-time high. But how does it affect the debt market? Okay, how do you combine the two? Inflation is high. What about the debt market? How does it impact it?
Yeah. So I'll just give an example. Let's say the February MPC this year, at that point of time, the CPI prediction for FY23 from RBI was around 4.5%. And that was subsequently increased in April MPC to 5.3%. Okay. Now, that is 5.7%. Now, that is a huge increase in what you call is CPI prediction for FY23. Then what the market understands is, the debt market understands is that the central bank has suddenly recognized that there is quite a strong possibility of an increase in CPI predictions for average FY23 by 120 bips. And that is a huge, huge change in inflation expectation from the RBI itself. And then obviously the market understands that if the central bank itself is increasing the inflation projections, then the kind of repo rate movement or the kind of monetary policy actions from the central bank will also be accordingly. And hence the GSEC yields started inching up post the sudden U-turn in the April policy. Till February, they were completely accommodative. They were prioritizing growth. because they had a CPI projection of 4.5% for FY23. Now, 24th February, we all know that Ukraine-Russia incident happened, and then in the April MPC, the MPC decided that I think for the next FY23, the CPI is definitely going to go up, and it is time to take care of inflation expectation, and that's why they have increased that CPI projection to 5.7%, and that implies a very strong possibility of monetary action from RBI at that point of time in 7th April. You would be aware that 2 days back, sorry, 2 days back itself, that RBI has done an out-of-turn policy meeting, and they have made an emergency repo rate hike of 40 bips as well as a CRR hike of 50 bips. This was very surprising for the debt markets. Immediately, what you have seen is that the entire curve from 1 year to 5 year, either in G6 or in SDS or in corporate bonds, have shifted upward by 50 bips. If you look at OIS itself, which is a measure of repo rate change expectations over a period of 6 months, 1 year, 2 year, 3 year, 5 year. So if you look at the OIS curve itself, the 1 year OIS have shifted up by almost 100 bips since the April meeting. Okay, and the 2 year OIS is almost pricing in a 7.5% repo rate by the end of 2 year. So that is a huge change in market expectations from RBI, and so that's what has happened in the market. So the point is that if CPI projections or CPI expectations from RBI itself goes on the increasing side, then the market has to respect that, and then the market yields change accordingly. And then,
so if I would put it very simply, like a crude manner, maybe not going on to the accuracy. So when the cost of money, which is inflation, goes high, so it increases, the RBI is worried about it because it pinches the common people, and to tame that inflation, to bring it control, they have a committee by the name of MPC, which is nothing but an RBI. So for the so RBI says, I need to control the inflation, and to control the inflation, they have a monetary tool which is interest rate. So they so interest rate they increase. So in the latest policy, one of the base rate, which is like repo rate, is the interest rate they increase. So when they increase the interest rate, the entire cost of money has increased. So the money has become more costlier. And someone who was getting, say, I'll take an example of bond. If was the bond was, if he was getting 8%, now the cost of money has increased. So the bond prices will go down. So is it right to say whenever there's an increase in the prices, the bond prices are negatively affected?
Correct. And you have to understand and appreciate one point, that the markets are forward looking. Okay, so before the RBI moves, the market is already pricing in that, right? Okay. So the current market is already pricing in almost the repo rate rising to 5 point whatever, let's say 5.5 or 6% by March 2023, and further then to 7.5% by March 2024. Okay, so that is the market, how the market behaves. That before the RBI moves, the market starts building it into yield and prices.
So as per your model, you said inflation, you gave us the projections of inflation for Q1, Q2, Q3, Q4. So I think you are expecting some more hardening. And yes. We would, the market is expecting the RBI to further increase the rates of repo rates or whatever tools they may be. They have different tools at their CRR, SLR, different tools, which will maybe later on we'll discuss in some other session. The bottom line is the rates are expected to increase in the future. So the prices of bond will be negatively impacted in future. Is that right expectation?
Yes, and most of it has already happened to an extent. Okay. So the way it happens, it's a continuous process. It's not a binary process. It's a continuous process. So the out of turn emergency meeting of MPC, the way the governor talked about, let's say, trying to control inflation, because in the long term to medium term, it is actually supportive of growth. The way they have cut CRR, they have hiked CRR by 50 bips. That all implies that the governor and the MPC is extremely, let's say, concerned about the next few CPI prints, and they want to control it before it goes out of turn. Now, the market is not going to wait for the RBI to actually do the repo rate hikes, let's say in June meeting. The market is already pricing in that there is going to be a 750 bips to 75 bips hike in June, 25 further in August and October. So that has already happened. Now, if things do not happen in June meeting, that there is no rate hike in June, then obviously the yields will cool down. But the yields have currently gone up because they are already pricing in that kind of action from the MPC in June meeting.
Okay, so now I understand. Thanks for explaining it so beautifully. Now I understand why my debt mutual funds are showing a negative NAV for last 2 days.
Correct.
So it's just because the CPI and WPI has crossed the threshold, which was a legislative mandate, and RBI had to act fast to control the inflation. They increased the interest rate, and since we know interest rates negatively affect the prices of the bond, that is why my debt mutual funds are showing a negative NAV.
Correct.
Thanks a lot.
Yeah. And just to add, there is a concept of what you call is let's say the neutral rate, which is, let's say, the terminal rate. When I say terminal, it means a stable long-term rate. So my expectation for terminal repo rate by, let's say, March 2023 should be around 5.75. Why am I saying that? Because if you have noticed in the press conference of April MPC, there was a talk of getting the real returns to positive territory. Okay, so if my expectation of CPI in FY23 March quarter is 5.75, then at least the repo rate has to reach to 5.75 so that the real rate is 0 or positive. Okay, so my sense is that by March 2023 we would reach 5.75, out of which the distribution of repo rate hikes could be 40, let's say, in June, 25 further in August and October, and then further on the remaining part of FY23. So you have to have a understanding of where the repo rate is headed on a long-term basis for, let's say, stable period. So I think that is how we need to figure out where the repo rate is headed. Also, we need to figure out what is the CPI projection for FY24. Okay, now FY24 is very important. I think my sense is that we would see around 5.5% FY24 average CPI. Now, if 5.5 is my average CPI reading for FY24, then definitely the repo rate has to be 5.5 or let's say around that figure. So we will see definitely 110 bips hike in repo rate in the next 6 months to 9 months.
Fair enough. So, in the interest of the time, let's move forward. We are on the first topic itself, and we've already consumed almost 30 minutes. Let's move forward.
Sure. Now, this slide is for the US CPI chart. Now, if you look at this chart, most of the times the CPI has been stagnant around 2% till 2020, 2021 March. Okay. But after that, it has now shot up to March reading of CPI was 8.5% in US. Now that is a huge change in CPI for a developed market like US, because traditionally developed markets are extremely productive economies where factors of production are extremely efficient. You do not expect to see CPI at such high levels. But why it is there? It is there because there has been a large amount of balance sheet expansion from the US Fed, which is the central bank. Pre-pandemic, they had a balance sheet size of around 4.5 trillion US dollars. Post-pandemic, right now, their balance sheet size is around 8.9 trillion dollars. That is first factor. The second factor is the US fiscal spending. The US government spending as a response to the pandemic was almost $5 trillion. Now that money is basically free cash distribution to the, let's say, the individuals in the US economy. And that has led to a huge amount of demand for goods and services, which has led to this condition. Now, in US, the mandate of US Fed is symmetric CPI around 2% on a consistent basis. Now, 8.5 is far away from 2%, and hence you would have seen the urgency in US Fed actions for hiking the rates. They have just done a 50 bips rate hike yesterday, day before yesterday night, and they are likely to increase the rates further by 150 to 175 bips in this calendar year itself, because they also want to control the inflation expectation. They would want this number to come down to, let's say, 3.5% by the end of this fiscal. If you look at Eurozone, again, Eurozone has always seen a CPI around 2% max till March 2021. But now that number is at 7.5%. Again, the same story. There has been a combined fiscal and monetary expansion, which has led to this condition of a very high CPI number of 7.5%. Again, ECB is perhaps one of those central banks which are more concerned always about growth than inflation. But again, the market is right now pricing around 75 to 100 bips rate hike in this calendar year from Euro ECB itself.
So,
yeah.
So before moving on to the next factor, I just summarize like the world over in a very layman terms, the inflation is the problem, and we expect globally, and we've seen in the US case also, the central banks to increase the rates. So we can expect in US, in Europe, in India, so rates to harden. Go north.
Yes.
Great. So let's move on to the second factor. And somewhere while you're mentioning Eurozone and you mentioned about growth. So would like to understand how does rates impact the growth?
Right. So this is a chart of the India's economic growth in terms of GDP. This is the chart of CPI. Just wait.
Yeah, because I was seeing that growth going into negative, so I got worried.
Yeah. No, there is some problem in the chart. This is not the chart for the India's GDP. It is not the chart. I think this is the same chart of Eurozone which has been replicated here. My apologies for that. So we'll come to the slide of the GDP growth, what has been happening in India's GDP for the past 3-4 years. Now you have to look at India's GDP from pre-COVID times and the post-COVID times, right? So pre-COVID times, India's GDP annual growth rate was around 7 to 7.5%. Now in FY21, when the first wave of COVID has struck, we went down to 6.6. In FY22, we were around 8.9. FY23, we are expected to be around 7.2% as per RBI. And then on a secular basis, we should expect 7.5% beyond that. Now, India's real GDP in FY22, that is estimated, the real numbers will come on 30th of May, is around 147 lakh crores. Pre-COVID, this number was 145 lakh crores. Now that implies that for almost 2 years, we have only seen an increase in GDP from 145 to 147 lakh crores. Why this has happened? This has happened because most of the times there was an economic output loss due to COVID, etc. in the past 2 years. Now there have been an RBI commission, RBI report, which said that the output losses for FY21 was around 19 lakh crores, FY22 was 17 lakh crores, FY23 was 16 lakh crores. That implies to recover this amount of output losses, you would need at least time till 2035 to cover these kind of losses. Now, my point is that post-COVID scenario in India, because of these kind of output losses for the last 2 years, the RBI rightly so was trying to protect growth by keeping a super accommodative stance. But now since inflation has gone beyond the 6% range and inflation expectations are likely to get unhinged if this continues, that's why now they are prioritizing inflation over growth. But the governor has a valid reason for protecting growth, because the growth needed to be nurtured. And especially you have to consider the point of fact that India's GDP statistics only cover the formal sector. There is no coverage of informal sector economic growth in India's GDP. There are only proxies for informal growth in India's GDP. And hence, my sense is that whatever numbers we are seeing are perhaps, again, not exactly correct, because the informal sector, which is the MSME, SME sector, or let's say small enterprises, they have perhaps not been able to first either increase their prices because their cost of production is very high and they can't compete with large scale enterprises in terms of let's say scale of efficiency, etc. So in the last 2 years or so, the small enterprises or the informal laborers, they have actually suffered a lot. And if we were to, let's say, actually add those numbers to the economic output, the real GDP numbers would perhaps again go down slightly. And mind you, these numbers get updated after every 2 years, after counting into the informal sector also. So my sense is that whatever numbers we are seeing right now, they would also drift slightly lower. Now, anyways, coming back to GDP, what are the components for calculating the GDP? Net exports, government spending on goods and services, investments, and household consumption. Now, in case of India and US, 60% of the domestic economy of the GDP is derived by personal consumption, which is the household consumption. It's a consumer-driven economy in both case of India and US. Now, just to give a technical background, GDP is basically gross value added plus taxes minus subsidies. You would keep that aside. We'll come to the next slide. So if you look at Indian GDP, services contribute almost 54%, agricultural 20%, and industry 26%. Now, if you look at the PFC, which is the private final consumption expenditure, which is the what I mean by household consumption. If you look at the first row, so you would see that PFC growth rate have actually slowed down in Q3 FY22. After the initial burst in PFC in Q1, Q2, that has slowed down. Why it has slowed down? Because, as I mentioned earlier, that after the reopening of the economy, initially there was a demand for goods and services, but later, as most of the economy has suffered because of lack of economic output, these numbers are slowing down. If you look at government final consumption expenditure, GFC, obviously when, let's say, the households are not able to spend, it is the government which is going to do some revenue expenditure and try to stimulate the economy. So if you look at these numbers in Q4 FY21, when perhaps it was necessary for the government to spend, they have done a significant amount of spending, but lately it has been moribund. Lately it has been little less. Gross fixed capital formation. This again, growth rate is, I think, anemic if you look in Q3 FY22 numbers, because beyond the government, private capex is yet to happen in the Indian economies. Now, my sense is that whatever numbers we are seeing on the screen right now, in terms of GDP, these numbers are going to, let's say, suffer going into the future, because as interest rates rise, their effect of lead lag into the economy would start impacting the economy in the next 6 months to 9 months. So if we are expecting a FY23 GDP of 7.2% as per RBI, realistically speaking, I think you will end up somewhere around 6.8 to 7% when the numbers come out. Now, why GDP growth is important from understanding bond markets is because if GDP growth is affected too much adversely, then the central bank is supposed to stimulate the economy either by cutting rates or by giving liquidity measures, as has happened in the case of post-COVID world. So we would remember the 27th March 2020 surprise meeting of MPC. They cut down the rates by 75 bips. You would remember the May 2020 MPC meet when they again cut down the rates by 40 bips and introduced many TLTRO, LTRO measures. So the current governor and the MPC has been quite cognizant of protection of growth since the last 2 years, which was much required also. But now the time has come that inflation needs to be prioritized, because in the medium term, inflation needs to be controlled so that growth is conserved, right? Because if inflation is too much, there would be not much savings, there would not be much investments, and then hence there would not be much economic output created.
Great. So thanks, Satyakam. And I think we are already running short of time. We have completed 2 factors, and it's already 43 minutes, and we need to give time for Q&A. So I'll just maybe for fiscal debit, we'll cover it next time. So I'll just whatever you've said, I'll try to understand, and you can confirm my understanding. So GDP growth rate is the growth at which the country is producing or growing. So in a very layman terms, when a country is growing, so the companies are growing, they are producing more, and the country is consuming more. And then when that is happening, the people, when the company is growing, they need capital to grow, so they borrow more. So they borrow more when the cost of capital, which is interest rate, is less. So when the interest rate is less, the companies borrow more, they put more money for capex, and the debt market is nothing. The debt market is nothing. It is the companies who borrow the money or the government. So anyone who borrows money if the cost of capital is low. So at the one hand, we have GDP growth. If we were to boost that, RBI has to boost growth, it has to keep the interest rates low. At the another end, you told there's inflation. If the inflation is high, to control inflation, one has to increase the rates. So RBI has to make a fine balance between trade-off between a growth and inflation.
Correct.
So if they increase the interest rates too much, inflation will control, but at the same time, growth will come down because the companies will be borrowing less. And if they keep the interest rate too low, we have seen the growth is good, but that comes at the expense of inflation. So these are the two opposing forces that determine the action of RBI. So currently, since the inflation has gone beyond the legislative mandate, RBI has rightly taken the hard pill of increasing the interest rate. And in the short term, there could be some growth stagnation, but in the long term, it would be beneficial for the economy as such. Is that a right understanding, to paraphrase it?
Extremely right understanding.
Great. So I'm sorry, to stop you at this, we are not going to, because we would like to take feedback from our audiences. We have been discussing it, so we are open for the question and answer, and I would request the participants to write their questions in the Q&A box, and Satyakam and we will take it. I think it's a question from Jasmeet. So he wants to know the impact of inflation to the equity market for the next quarter.
So there are two impacts. First is the direct and the second is the indirect. The direct impact is that as interest rates are being raised, you would see the cost of, let's say, interest cost of these listed companies go up. The cost of borrowings from debt capital markets would increase, or even from the banking system. So on that basis, their EBITDA margins would come down, and in that way, it is slightly negative for the equities. The indirect effect is that as interest rates rise, the cost of capital goes up, the discount factor goes up, and hence the earnings growth come down. So, I mean, combining these two, you can say that equities are in for a tough time in the next 6 months to 1 year, considering that there's going to be a series of rate hikes, not only locally, but globally also.
So it's a start of a bear market. So we have been on a bull market for a long time. I think the tide is turning now.
Yes, yes. So I think anyways, the valuations were too elevated, not only for local markets, but for global markets. So anyways, if you look at S&P, the lifetime high was 4,800, now it is 4,100. So it's almost corrected by 15-16%. And if it corrects more by 20%, then it officially enters into the bear market. Fortunately, in India, even after $22 billion of FPI outflows since October, we have still fallen only by, let's say, 7 to 8%. So we have not fallen as much as, let's say, US, and I think that's good. But I would be very circumspect about equity markets for the next 6 months to 12 months. It's a very tough time for equities for the next 1 year.
So I'll just take an extension of that question. So equity markets are going to be volatile market, and we have already discussed debt funds since the expectation of the inflation is higher. So the RBI taking the interest rate hike is priced in. So the bonds, mutual fund bonds yields. So where does a common investor, layman invest? What are the avenues left with it?
Right. Interesting question. So I would definitely be out of equities. Last time also we have discussed that. Now coming to fixed income, if you are sure about the visibility of your funds for, let's say, 3 years, 4 years, 5 years, then you should look into 3-year, 4-year, 5-year SDLs because they give very good post-tax adjusted returns. You can also look at credits, AA plus credits, which give you very good credit spreads right now. I mean, if you look at certain names, I don't want to use any name, but the credit spread is exceptionally high. And these are the papers where the amount of carry is so high that even after a certain amount of MTM variation because of yield curve moving up, I don't think you would end up. I think actually you would end up making more money than you would make in a, let's say, overnight fund or liquid fund, or for that matter, an FD. So my sense is that AA plus credit names you can look at right now. Economy is doing actually decently well. So credit spread compression could happen in the next 1 year, 2 year. Anyways, credit spreads I think are right now mispriced for many of the names. So there you have a decent opportunity to invest, especially if you have a visibility on that fund for the next 2 to 3 years.
So what I take away, if you have money, you invest in a credible opportunity for a short period of time where the impact of interest rate would not be that
Correct.
great. Okay,
Correct.
fair enough. So you hold to maturity. Whatever
Yes.
you buy
Yes.
it and you keep it in the locker.
Yes.
Pretty good.
Yes.
So
And just to add, I think the current market pricing of interest rate hikes by RBI has gone to an extreme, I think. So if you look at 1 year OIS, it's now almost pricing in 200 bips repo rate hike by March, okay, which is exceptionally high, okay. So if you get 1 year, let's say AA papers at a spread of let's say 200, 300 bips or 400 bips over GSEC, one should look at it because not only the carry is good for you, I think these spreads would anyways compress. Plus, there is an opportunity of M2M gains also.
great, great. So you'll keep this in mind, Satyakam. Next time we will our endeavor on the Giraffe to list such opportunities and
Yes, yes.
offer more opportunities to our investors.
Yeah, because these are short-term papers, 1 year, 2 year papers. And if you have done your due diligence correctly in terms of credit research, etc., even AA plus names are good names to go for 1 year, 2 year paper.
Definitely. So next question is from DL. Uh, so the question is, as rates inch up over the next 2 years, how does that impact the banks, apart from the obvious impact on the credit demand?
So in India, unfortunately, what happens is that when rates go up from RBI, it's only the lending rate which goes up. The deposit rates take their own sweet time to go up. So for banking sector as it is, I think it is a good time that their net interest margins will increase. On the treasury investment side, their portfolios might take a hit because obviously if the yield goes up, the prices come down and their overall treasury investment valuations will come down. But net, my feeling is that it's going to be a good time for Indian financials for the next 2 years, 3 years in a rate hike scenario. Plus, the NPA issues are anyways resolved. So I think it's an interesting time for financials right now.
I think we'll discuss it next time, Satyakam, because I have a totally different view. So,
Okay.
so
Sure.
I think during the interest rate increase regime, the NI NIMs get squeezed for the bank and the credit offtake is low. And during the easy money, those corporates which have gone for a capex, and once the interest rate increase, the gross NPA, the probability of going them is higher. So it's a different view I have. So we'll discuss it next time.
Sure.
So there's another question from Mr. Anuj Pratap. Is there a risk of recession in Indian economy if the central bank increases the interest rate? As we have seen, the PFCs has been decreasing and the inflation is not an outcome of excessive demand. A very beautiful question.
Is there a risk of recession in Indian economy? Central bank, as we have seen, the PSA has been correct. So this question is basically saying that if the current inflation is an output of supply side issues and not because of demand issues, then will you be able to solve that issue, resolve that issue by taking interest rate hikes?
Correct.
Frankly speaking, technically speaking, no. But you have to keep in mind that sometimes interest rate hikes are done so as to reduce the aggregate demand in such a way that maybe some amount of output is lost, but you have to bring down the inflation expectations in the economy even at the cost of sacrificing certain amount of output. Okay, so yes, 1 year down the line, maybe we will see the entire global economy going into certain kind of recession or lower growth scenarios because that's what likely going to happen. In case of India, also you might see that. But the need of the hour is interest rate hikes because right now we need to contain the inflation expectations before it becomes unhinged. Because once it becomes unhinged, then it's very difficult to control inflation. Then you would see the time of 2013, 11%, 12% inflation, which is not good for anybody.
Okay, so I think I would not like to put a very strong word, the risk of recession. So another way to put it, is there a risk of stagflation?
Definitely, yes. I mean, for the next 1 year or so, we will see, let's say, anemic growth numbers. We will see elevated inflation numbers, and that should be a cause of worry for all central bankers, not only Indian central bankers, but for US and Europe as well. So stagflation is quite a definite reality.
Okay, fair enough. So I think we have almost been discussing for an hour, and I would urge if there are any other questions from audiences, and I can see that it's a quite elite audiences who have asked such questions.
Yes, the questions are very smart.
Yeah, they're very smart actually.
So we will cover the remaining topics, fiscal and trade deficit, current account deficit, BOP, etc., repo rates and GSEC yields in the next seminar, monthly seminar. And by that point of time, we would have seen the June meeting of RBI also. So let's hope to have an interesting discussion then.
Right. Thanks, Satyakam, and I would like to thank all the participants who joined us on the Friday evening, and we look forward for a much more interesting discussion and learn from the experiences of Satyakam. Thanks, everyone, and have a good evening.
Yes, sir. Thank you so much, Vikas. Have a good day. Bye-bye.
Thanks, Satyakam. Bye-bye. Take care.